As per the book, this is chapter number 2. So, in this part, we are going to study economic methodology, where we will observe economics as a social science, positive and normative statements, meaning of the term ceteris paribus, and importance of time period, where we are going to study in detail what does short run, long run, and very long run mean, and why they are important. So, let's talk about microeconomics versus macroeconomics. Micro, as the name suggests, focuses on tiny or small parts of the economy, and macro means bigger part of the economy or focuses on the bigger picture. What is microeconomics? Study of individual markets, looks at the behavior and decisions of consumers, businesses, and how they interact with each other. An example of microeconomics topic is factors that explain why consumer buy some goods and not others. Macroeconomics, on the other hand, studies the whole economy or group of economies, looks at how consumers and firms interact but on a broader level, right? It will include some of government intervention as well. An example of microeconomics is reasons why one economy grows at a faster rate as compared to the other economy. The question here is, why do we need to know the definition of microeconomics and macroeconomics? Because we do get questions about micro and macroeconomics in MCQs, means in paper 1. So let's talk about micro and macroeconomics in a bit of more detail. So, microeconomics focuses on individual markets for goods and services. Let's write it down. So, we will write micro, then here we have macro. So, the focus is individual markets for goods and services, right? Market is smaller than industry, right? Okay. Second is studies supply and demand or interaction between supply and demand. Okay. Next is it studies how institutions and taxation, impact of taxation on individual choices, right? And then it includes topics such as demand theory, production theory, and competition. Macroeconomics, on the other hand, is it focuses on broader economy and talks about topics such as employment, inflation, and GDP. Second is government intervention. It focuses on government interventions for economic growth or government measures for economic growth, including the fiscal and the monetary policy. And yes, factors impacting GDP. Now, I'm sure that you have a better understanding of what these two mean. The split between microeconomics and macroeconomics is institutionalized in economics from beginning courses through the postgraduate studies. It means that these both are important fields that impact each other. None of them is independent, right? And for example, individual decisions made through microeconomics can shape the broader economy and can have an impact on macroeconomic decision making. Now, let's move ahead. Positive versus normative economics. We have positive statements and normative statements. So, what are these two? Positive statements focus on describing and explaining economic phenomena based on observation, facts, and data, essentially analyzing what is, right? So, positive statements can be falsified or proven, they can be verified, at least in principle, such as right or wrong. They can be tested against facts and data. For example, a minimum wage policy will increase employment among unskilled workers. This is a hypothetical statement, and you can test it and find out the answer as yes or no, or to what extent it's true, to what extent it's not true. Normative statement, on the other hand, deals with subjective value judgments. Value judgments are subjective. It means that it can vary for everybody. It's not the same for everyone. It's based on opinions and statements that cannot be falsified or proven right or wrong. For example, if you have a perspective about something and I have a perspective about something, we both can have different perspectives and none of them is not necessarily wrong, and both of us can be right because it's based on our opinions, our experiences, our knowledge, etc. It's subject to a lot of variables, therefore it cannot be falsified and it cannot be even validated. If you say you think this, then yes, you think this. I cannot prove that you are wrong, and I should not have any need to prove you wrong. Example, inflation is rising too fast. It's subjective. Too fast for you can be different. Too fast for me should be different or could be different. Key phrases in normative statements include ought to be, should be, too much, too little, is fair, is unfair, and so on. Again, why do we need to know about these statements? Because we do get questions about them in MCQs. So, what is the key difference of these kinds of statement? The key difference between these two kinds of statements is the focus, right? The focus of positive economics analyzes economic phenomena as they are. Focus on what? Objective matter and subjective matter. The focus of positive statement is on objective matters, and focus of normative statements or normative economics is on subjective matter. Number 2 is statements. What do I mean? Positive statements can be tested and verified. So we can say verifiable, while normative statements can be used to only advocate or express our ideas, right? So what do I mean by verifiable? I can verify a statement with data or evidences, whereas normative statements cannot be verified because those are opinions and subjective in nature. Third is application. Okay, what do I mean? Positive economics is used to predict economic outcomes, whereas to understand cause and effect relationships, while normative economics is used to advocate for specific policies. Okay, predict versus value judgment. I think value judgment will come here and advocate will come here. Yeah. Now, predict outcomes means to understand cause and effect, whereas normative statement can be used to advocate for specific policies or actions based on what can be considered desirable or appropriate. Examples of positive statements include increasing the minimum wage will lead to decrease in unemployment levels. This is a verified fact. When minimum wage levels increase, more people are willing to work, right? So it will lead to decrease in employment levels. Normative statement: government should raise minimum wage to ensure a living wage for all workers. When wage is increased, it does not ensure that living living wage for all workers requirement for living wage for all workers will be met due to other variables such as inflation. Okay. Then we have ceteris paribus. What do we mean by ceteris paribus? This is an economic concept where we see that we hold all other variables constant. So ceteris paribus is basically a Latin word and it means all other things being equal. Why do economists use it? They use it to describe a situation where certain factors are held constant, holding constant all other variables that may affect the second variable. Example: in science, you might use ceteris paribus to describe law of gravity. For example, an apple will fall to the ground if you drop it from a tree, assuming no outside factors such as tornado or wind are present, right? Second example of ceteris paribus is in economics. It can be used to describe how changes in one variable affect the other variable while assuming that all the other factors remain unchanged. For example, wage would lower unemployment if minimum wage would lower unemployment if all the other factors remained unchanged, right? So this is an example of ceteris paribus. Another example of ceteris paribus is the law of demand. We say that when prices come down, quantity demanded changes, and we are not taking into account any other factor that may impact the demand and other than price. Or even if the price comes down, people may not want to buy more of that stuff, right? So that is called ceteris paribus. All right, now let's go back and see how many topics we have covered so far and how many we need to cover. All right, importance of time period: long run, short run, and very long run. All right, the concept of margin. What is the concept of margin? Margin or marginal refers to when we are talking about increase of 1 unit, right? 1 unit more. For example, we have marginal cost and we have marginal utility. What is marginal utility? Utility is satisfaction. For example, earlier we were manufacturing 10 units and the total cost was $100. When we manufactured one extra unit, the total cost became $110. So marginal cost becomes 110 minus 100 is equals to $10. That is the marginal cost, means cost of producing one extra unit. Now, if we are using 10 units of something, of a good or service, total utility or total satisfaction that we are deriving out of it is 25 utils. As soon as we start consuming 11 units, the satisfaction becomes 27. So, marginal utility becomes 27 minus 25 is equals to 2. It's not in dollars, it's in 2 utils, right? So, let's see what the book is saying. The economist means small change in one variable such as income will lead to further small changes in other variables such as consumer spending, imports, etc. We use margin to analyze issues that enables economists to predict the likely impact of change might be by changing one variable, how will it impact the other variable. It means cause and effect, right? The concept of margin is used basically in decision making, and businesses or firms use it to study how much impact will a small change in price have on the quantity demanded. Consumers use it to analyze a small change in their income, how will their demand for certain good and service will be impacted by a small change in their income, right? Whether they should reduce the demand, whether they should increase the demand, etc. Next is importance of time period, right? Now, what is short run? Short run can be defined as a period where at least one factor of production is constant, right? It is possible to change only some input and at least one factor of production is constant, which one factor is normally capital, because you cannot change capital very rapidly, and the variable factor of production is labor, as it can be increased and decreased to change what the quantity of goods and services produced or to meet the changing demands, right? For example, any firm that wants to meet increasing demands of goods and services can readily change labor, but they cannot change the amount of capital. They cannot get machinery there and then, right? So, in the short run, one of the factors of production is variable, is constant, and that factor is normally capital. What is the long run? In the long run, you can alter all factors of production, because and you will come across ideas such as profit in the short run, profit in the long run. In the long run, you can maximize profits by bringing down cost, because in the long run you will be able to alter all factors of production, you including capital, labor, capital, and all other factors of production including land are variable. It will, because in the long run, the long run period allows the firms to be more efficient, means they have time to assess what they should include, how much they should include, and they have time to arrange for factors of production as well. In the very long run is not only where all factors of production are variable, but all other key inputs are also variable. Those inputs include technology, government regulation, and social concerns as well, right? So, when we are talking about long, short, and very long run, we take into account the variability of not only factors of production but inputs also. How does in the very long run technology, government regulation, social concerns change? Of course, in the very long run, you can adopt new technology if new technology is introduced. Technology is not introduced every other day. It takes years, or in this present times it takes at least 1 year or 1.5 year or at least 2 years to introduce new technology. Once that technology is introduced, you adopt it to improve your processes and reduce your cost in the long run. Government regulations can change, and government regulations do not change every now and then or every day like it happens in Pakistan. And social concerns also do not change within 1 year, it takes decades. For example, earlier, after the Industrial Revolution, nobody was concerned about pollution and people were not concerned a lot about environmental damage. The activities of firms and manufacturing firms cause cause, right? But in the long run, in the very long run, after many decades, people started showing concern for environmental protection and environmental sustainability. With this, we come to the end of topic 1.2.